Welcome to Wealth Matters, where we discuss the opportunities and challenges of preserving and managing wealth. This show is presented to you today by Gaslowitz Frankel, a law firm dedicated to resolving disputes involving your wealth, whether it be through your will, your trust, your business, or your investments. For news, pictures, and tips, go to our website at gaslowitzfrankel.com or follow us on Twitter at Estate Dispute. Our show's hashtag is Wealth Matters. Your hosts today are Craig Frankel and Robert Port, and we're talking about the issues and challenges in structuring and managing an investment portfolio. As you may know, our law firm is participating in a year of charitable giving in celebration of our 25th anniversary. So before we start the show, we want to thank our employees for giving to some wonderful charities so far this year, including Families First, Hero Box, Atlanta Pet Rescue, and Hillside Hospital. Follow us on Facebook at Estate Dispute or on our website, gaslowitzfrankel.com, for updates.
And now it's time to introduce our guests. We're pleased to have with us today Bill Leonard, an attorney with Taylor English Duma, and Lane Steinberger, partner and chief investment officer with Redwood Wealth Management. Let me ask each of you, Lane and Bill, to give us a brief overview of yourselves, what you do, and the firms you work for. Bill, you first.
Okay. I grew up on a farm in Alabama, but I guess you don't want me to start that far back, do you? I've been a lawyer in Atlanta for 36 years. And over the last several years, I've been with Taylor English Duma, which is a firm that started 10 years ago. In the 10 years...
He says several, he means 9 years.
Yeah. The firm's grown in those 10 years from 4 lawyers to over 130 now. We do pretty much every area of the law, but my practice is on business litigation. I've done, in the investment arena, I've handled arbitrations on both sides, really, for claimants at times and for brokerage firms and registered representatives, which is a little unusual. Lawyers tend to work on one side or the other and not both. Beyond that, I've done securities laws, class action defense work, a lot of corporate governance work, which is helping business owners with internal disputes between shareholders of a company or members of a limited liability company or partners in a partnership. And then during the recent economic downturn, Georgia had the dubious distinction of being #1 in bank failures, and I did a lot of work for the FDIC investigating failed banks and sometimes bringing claims against directors, officers, accountants, lawyers, and so forth.
And our guests may be interested in knowing that I met Bill first when we opposed each other in a case. I was representing some folks who had some issues with how their investments were handled, and Bill represented the advisor and his firm. And I think our listeners may be interested to see that even though we can be tough adversaries, we can also get to know each other on a different level. Lane, tell us about your practice and your firm.
Well, I've basically been in money management in some capacity for the past 20 years or so. I originally started out in currency trading and eventually moved on to working in the pension fund right here in Atlanta, Bell South. It's actually a pretty sizable fund, about $20 billion. And once Bell South eventually got bought out by AT&T, they basically said, you can go to San Antonio, New Jersey, which one do you want? And my wife was from Atlanta, we were on our first child, and she said, we're staying here. So, needless to say, I started my own money management business. And eventually merged that firm with a couple other guys here in Alpharetta, Georgia, and now we manage about $400 million, mainly for high net worth individuals, and we not only do money management, but we also do financial planning in addition to that.
Okay, thank you. Now our topic today are the issues and challenges in structuring and managing an investment portfolio. So let me ask first this question, just broadly, to you, Lane, which is, talk broadly about the types of strategies that different advisors may have from a continuum, as I understand it, from passive to active, as well as some of the academic theories that inform how one invests, and if you will, feel free to describe how you approach it and your reasons for adopting the philosophies you've approached.
Well, that's a big question and can be a long question. Generally, there are all types of advisors out there. You'll see advisors at firms like Merrill Lynch and Morgan Stanley. They tend to be the large brokerage firms. You also see insurance companies also offering investment type strategies. And generally in the past, and really still even now today, that most of the industry has been very commission driven and very transaction driven, meaning that someone calls you up and says, "Hey, I got a great stock for you. You need to buy it. It's going to go up." And a week later they say, "Oh, that stock's no good now. Let's sell it." And because I'm thinking it's going to go down, and the person generally makes a commission on that transaction. So, this type of an advisor, in my opinion, is not the best way to go. In general, that person's a salesperson who they're hired to sell. So when these large brokerage firms come in, they're not looking for a guy with what's called a CFA, a Chartered Financial Analyst, which is almost a requirement in the world that I came from, the pension fund world, where you're dealing with large institutional managers. They're looking for the type of person that can sell and that can bring in the most business and create the most transactions. We operate a little bit differently. We're what's called a fee-only advisor. And being fee-only means that we're not worried about selling you a great stock or selling you a great sector. And the example I like to give clients is, in the pension fund world, we didn't have stockbrokers calling us up. We had, we had large portfolios that we dealt with that we spread out among all different types of investments across the world, mainly using fund managers. There's kind of a myth out there that, I need to buy a great stock, or I need to, 30 great stocks and 30 great industries, and my returns are going to be higher. And we're not big believers in that. We're big believers in, you can have 10,000 stocks in your portfolio and still get higher returns via mutual funds.
When you're doing investments now and you are a CFA, do you do the investments yourself, or you're still going to be using a broker to place or own them?
Well, there's all types. So, our firm's fee-only firm, we're independent, meaning that we have a custodian involved. So most of the, basically all the accounts are held at Fidelity Investments, or it could be Schwab or TD Ameritrade. Those are popular custodians that independent advisors use. So we generally would go through Fidelity. You want that. I mean, you think of the Bernie Madoffs of the world. He did not have a third-party custodian in between him and the client. He had, his custodian was Bernie Madoff Securities, and it allowed him to manipulate the statements and such, and have control over what the client was seeing. The way we operate is your investments reside at Fidelity. We have no control over what Fidelity shows you, meaning they send you the statement. You go to fidelity.com every day and can see your investments.
So to our listeners, one thing you're suggesting is, regardless of which advisor you use, you want to make sure that you're getting independent reporting, so at least you can see what's going on.
Exactly.
Okay.
Exactly. And that did not happen in Bernie Madoff's case.
Bill, let me ask you a question before we jump into how one goes about investing, because I'm always interested in how one chooses an investor. And sometimes you choose, your insurance agents by who you go to church with or who's on the softball team. But let's assume we're going to do a better or a more thorough examination. You're looking at investors for your clients, or you're seeing a dispute. Are you looking for those who are independent investor advisors, or are you suggesting brokers or some combination?
In my line of work, I don't usually make those kind of suggestions, and clients don't ask me really that kind of thing. But I mean, for myself, I'm more interested in someone who is not the sales type, who's not out to sell, and I certainly don't. I don't go along with the cold calls that I get occasionally from young brokers trying to build a book. But I like the idea of an independent money manager. I also, frankly, myself am now dealing with a Scottrade account and kind of making my own choices after several years of not being very satisfied with the advice I was getting. So there are different ways to do it.
And Bill, as I said at the outset, and you said at the outset, you've been on both sides of these type of cases, both defending advisors and pursuing claims against advisors. When you think back to the extent you have a thought about what gets people into trouble or the challenges that an advisor has in managing someone's portfolio, do you have any sort of broad observations about, you know, what it is that those challenges are from the advisor perspective and how they're dealing with their client, the investor?
My overall advice is document, document, document. I mean, so many times in these disputes, it's a he said, she said situation where the broker is saying, I warned the customer about this and he refused to listen, and the customer's saying, he never told me that. I would have done differently if he'd told me that. And there's no contemporaneous notes, there's no confirming email, there's nothing but one's word against the other, and it's who knows how that's going to turn out in a court case or an arbitration. So to me, that's one of the most important things. Now, from the broker's perspective, that's sometimes easier said than done, because the compliance department at a typical brokerage house doesn't want the broker shooting out emails all the time. They want some control over what's going out, and it can be sometimes a cumbersome process to get an email out for a broker. But I think that's important to do what the registered rep can do to document things that he or she is doing.
The word is communicate. The more you tell, the less likely the dispute, or more likely the dispute will come faster when it's a smaller dispute. From a broker side or from a fiduciary side, what I find the best is, even if you can't get an email out, jot down notes to the file.
Yes.
Have it done contemporaneous. And if you are the customer, write down the advice that you got and ask questions, because all of us, and this is kind of the beauty of a financial planner or advisor, we don't necessarily, as customers, we're not sophisticated enough. We sometimes don't really understand. We think we did, but the truth is we didn't.
Yeah, my sense of it is that the lack of understanding requires some education by folks who are advisors, and oftentimes I think I see a disconnect between what the advisor wants and what the client wants. For example, a client who wants to generate a lot of income in an environment where that's not possible, or a client who wants very high returns, beyond market returns, quote, beating the market all the time, when that's not possible. And sometimes I've often thought that to avoid some of the issues I see advisors get into, they ought to refuse to take on a client if there's a mismatch like that. Have you ever thought about that, Ryan?
Well, to add to that, you know, coming from the institutional world to the retail world, you find that you know, you see these funds out there like PIMCO Total Return Fund. That at one time was the most popular bond fund in the U.S. and one of the most common funds that you see most advisors use. And, you know, my find is when talking to advisors in the retail world, 99% of them had no idea what was in that fund. So when you opened up the prospectus of the PIMCO Total Return Fund, literally there would be 20 pages just on the amount of credit, or listing the credit default swaps, common derivatives that you heard a lot about during the 2008 crash. The majority of buyers did not know that, so there were a lot of it was basically a sophisticated type of hedge fund, not a pure bond fund. So it's not just the people that need to be educated, it's also the advisors out there. I mean, the biggest problem with the industry that I see is the fact that, I liken it to the lawyers right here. I mean, they go to school for 4 years, undergrad, and then they go to law school for another 3 years. And then after that, they have to take a rigorous exam and pass that exam to become a lawyer. And you know how long it takes for a doctor, and they have a similar situation, if not more school. Investment advisor can basically go from bagging groceries to becoming an investment advisor in about a month. They have to take, a Series 7 exam. It's tough. It's not that hard. So you see a lot of advisors that, they may be offering up these investments and this advice, and they really don't completely understand it themselves.
You are listening to Wealth Matters, the radio show where we discuss the opportunities and challenges of preserving and managing wealth. We are your hosts. I'm Robert Pork, and with me is Craig Frankel from the fiduciary litigation law firm of Gaslowitz Frankel. We're talking today with Bill Leonard and Lane Steinberger, discussing the topic of issues and challenges in structuring and managing an investment portfolio.
Let's start with some education stuff. So you're a client coming in, and what I just think I heard you say is before you choose your advisor, you're going to need to know a little bit about what they do and their background. And so one of the first things we would tell our listeners is look at them. Don't just talk to them and see that you like them. Go look at their website, see their education. But let's do the other side. You're now an investor, advisor, and a new investor comes in. What are some things that you need to be suggesting to them, and what should they be thinking about as they get comfortable with you? And I'll tell the story, of course. Every time I've been to an investment advisor, the first question I've got is, what is your risk tolerance? A question that I am not capable of answering without some guidance.
That is probably the toughest question out there, and we used to have all sorts of ways to tease out what your risk tolerance was, and we thought they worked well until 2008, and we found out very quickly that people that thought they had a high risk tolerance did not. 2008, if everybody remembers, is when the stock market effectively dropped about 40% during that time, which was a pretty large movement to the downside. Which scared a lot of people. For me, it starts, I'm actually a certified financial planner and CFA, so for me it starts with a financial plan. The first thing I'd want to sit down with you to do is, before I even look at or decide on your portfolio, is to look at your retirement plan. And that can vary. If you're 30 years old, your retirement plan is going to be a lot different from somebody who's going to retire next year. So
let's break it down into simple parts for us to look at. So one of the things you're saying is let's look at how soon you're going to be retiring. So what you've got already and how soon you're going to be retiring. What else do we look at?
First of all, what your income is. How much can you potentially save? What your expectation is. What do you want to retire, have 10 homes across the world, or are you have a lifestyle where you're probably going to stay in the same small house, have it paid off by the time you retire? So there's various things there.
And let's talk about anticipated income. I am shocked. I have a college kid, and I am shocked by what I hear him saying about where he's going to be working and how many jobs he's going to have. But the numbers are shocking. It's like he'll have estimated 20 or 30 jobs between now and retirement. When I was graduating from law school, the view was 2 or 3. Now, if you graduate from law school, it's 5 to 10. Even if you stay as a lawyer, how do you advise somebody who's in a job that may not be there 10 years or 2 years from now?
Well, the job doesn't concern me. It's how well they save, and if they're going to save. I would tell your son to start saving right away and very early. The biggest issue that we see with kind of the...
Maybe you should tell him. He doesn't really listen to me.
Well, send him in. I see a pretty big issue, especially we deal with a lot of young professionals, with young professional types. The retired types, retired clients that we have, and typically have some sort of pension fund. Well, those are going away. So they didn't necessarily have to save a lot in their 401k because they knew they'd have a pretty big pension coming. So they never really teach their kids that they need to save. And the thing is, to replace a $40,000 pension a year, you need about $1 million. That's quite a bit of money. So I think there's a big issue with just how much you're saving. They can change jobs as much as they want, but immediately get in that 401k and treat the 401k as a tax, meaning that You know, you can put in about $18,000 a year in your 401k. Get it in there and start it early. If you start right when you begin your first job, you know, at 22 and continue that, you're going to be, you know, pretty wealthy by the time you hit your 40s and 50s.
So when you say looking at savings, you're not only looking at how much you save, but your pattern of saving over time. Whether you were making $20,000 a year or $200,000 a year, how you go about saving.
Oh, exactly. I mean, it's basically the concept of, if you ever read the book about the millionaire next door, you don't necessarily need to make a lot of money to save up $1 million. It's just about when you start saving and how much you start saving right away.
And Bill, let me turn the question sideways. So when you see clients who have difficulty with their investments or their advisor, how many relate back to having different expectations when they started?
I think quite a lot of them do. A lot of times the broker is not asking enough questions and not really getting to the heart of things like risk tolerance, and then not continuing to talk to the customer as the relationship builds, but kind of going off on his or her own with things, whether it's a discretionary account or a non-discretionary account, just kind of doing things without adequate communication. So I think a lot of that hinges on a bad start to the relationship that then gets worse progressively.
And I will tell you from our side, where we're seeing disputes when they really get heightened, we go back and look at the original file. And one of the things we always look at is the investment policy statement. And it is shocking sometimes how the investment approaches that are used don't match that statement. And so what I would tell clients, potential clients, is when you meet with your broker, look at that statement a lot. Make sure you understand it and revisit it from time to time. From the investor side, from the advisor side, make sure that statement is updated and reflects the changes in whatever circumstances your client has. So let's jump into that. So now you've got the client, you've talked them through kind of what they should expect. Now kind of talk about, if we can, and Lane, we can start with you, what are their choices for the types of investing? What types of strategy or things should they be looking at? Or should you be looking at with them?
Well, there's 1 million strategies out there. You know, it starts with individual stocks. We don't generally recommend individual stocks. In my opinion, you don't. It's a myth, you know, to believe that you have to own individual stocks to achieve higher returns. We begin with mutual funds, and there are all types of mutual funds out there. You know, it starts with stock funds. And, you know, we analyze people's portfolios from other firms when they first join our firm. And the main issue I see is the lack of diversification. And diversification means that the majority of their investments that I see are heavily weighted in large blue cap firms, you know, like Apple and IBM and the big companies that you hear about every day. There's a couple of reasons for that. I mean, people like to invest in things that they know about, and the large firms you hear about every day, and you use their products every day.
When you say heavily invested, give us a percentage so we know what we're measuring.
Well, heavily invested, meaning that they would have, you know, again, it depends on the person, but 80% of their stock portfolio in large cap blue chip stocks. Again, people are familiar with them, and in the brokerage world has pushed those quite a bit, not only in the via funds, but also individual stocks. Again, because people are familiar with those stocks, and that's what sells. So my first recommendation generally in that case is, hey, we need to get this portfolio diversified. Diversified mean that there are mid-cap stocks and small-cap stocks out there also in the U.S. An example of mid-cap stock would be Under Armour. It's a fast-growing stock. They're not quite a large cap. They're right in the middle. A small-cap stock may be, Domino's Pizza. It's a small-cap stock. So
No, it's now Domino's. They dropped the pizza word. Because they sell so much other food. So when you talk about diversification, though, you're talking about now between kind of classifications. So different types of stock, different types of bonds.
Well, different types of stocks. So you have all different types of you have all different sizes of companies, but also internationally, and that's a big problem I see these days too, is the fact that people don't have enough international stocks in their portfolio. People tend to view international stocks as being very risky, meaning that they tend to move up and down, much more than the U.S. market. However, they're good diversifiers, and it's the old "don't put all your eggs in one basket." The United States is a great country. I believe it's going to continue to grow. I think we're, just our entrepreneurial culture that we have is going to just encourage a lot of innovation and great companies. However, things happen, and there are a lot of good companies overseas. I mean, people don't think about Samsung. Samsung is a Korean company. Well, that's considered an emerging market stock. Some people view emerging market stocks as risky, but Samsung's a pretty solid company. BP is another one. BMW, is a German stock. So you need to have all these other types of investments in your portfolio, not only domestically but also internationally too.
And Lane, being the good attorney, even though you've mentioned a number of individual stocks, of course nothing we say here is a recommendation, but you use those as examples of why one should diversify and examples of companies perhaps located in other places or in other industries that lead to diversification. Bill, when I look at a case, and generally I often do cases on behalf of investors, as you know, and I see an issue with respect to diversification, one of the things I do is try and look at how a diversified portfolio would have fared and sort of do a comparison there. And I'm wondering, when someone comes to you on the investor side and they may have an issue, how do you go about, as lawyers, not as investment advisors, how do you go about determining whether or not someone in fact has had an issue, what we would call one of the challenges in our show here about structuring an investment portfolio, or whether someone is simply, perhaps because they don't understand that the stock market doesn't always go up, that it's part of the risk that was appropriate to them. How do you go about sort of working in that gray area there, where you can't look up in a book that if you're so and such age, you should have this much in this type of stock or this type of stock or this type of return?
Well, each individual has the right to be as risky or as conservative as the person chooses to be. So I start with the account opening documents to see what sort of risk tolerance the customer signed off on and start from that benchmark. And then I look at what happened, what was actually invested in, and see, did that fit the criteria? I had one case for a claimant one time where in the arbitration, the broker admitted that the two stocks that were the main cause of the losses he would consider them to be speculative. Well, speculative was not even one of the choices that the customer had put on the form. So the broker looked silly at that point. He had clearly messed up. So, I start with that, and then I also look at any kind of market indices I can find that seem more closely aligned with what the customer really wanted, whether it's Standard & Poor's or other measures. And of course, if you actually go into an arbitration, you may need an expert to address those issues as an expert witness.
And what you've referred to is sort of a component, or maybe even the flip side of an investment policy statement, which is, as you know, in the brokerage world, there's this concept of know your customer, where you go through some of the types of things that Lane was speaking about before, about the customer's net worth, their income, their risk tolerance, their needs, their age, and so on and so forth, so you can try to develop a portfolio strategy that's consistent with what they want. And as you said, it's entirely up to the individual. If someone is very young, and even though the academic research might suggest that it's appropriate for them to be more aggressive, if all they want is CDs and that's the only risk tolerance they can handle, then that's what's appropriate for them. Let's move to a...
Before we jump off on that.
Sure.
One thing that I wanted to ask about is, how do taxes play into the investments? So you're talking about diversification, you're talking about risk. How do you evaluate, particularly as a financial advisor, how do you evaluate somebody's tax risk that will affect their investments when they really may not be able to explain it to you?
Yeah, that's a good question. First of all, before I jump into that, we've got to mention bonds here. People tend to shy away from bonds when we talk about investments, and to me, they're a very important part of the portfolio, and they've gotten kind of a bad rap, especially after the past couple of years. Given that bond interest rates have dropped significantly. But in every portfolio needs to have some amount of bonds in it. The biggest thing you need to know about bonds is that they are a risk reducer, meaning that they'll be there when stocks aren't, as long as you have the right type of bonds in the portfolio. I look at 2008 when stocks dropped about 40%. Well, bonds were up 5%. So, I was reading in the Wall Street Journal almost every day during that time how somebody was about to retire and couldn't do it because the stock market had dropped off so significantly. My first question was, how much bonds do they have in the portfolio? If somebody's close to retirement, we typically have a significant amount of bonds in the portfolio to protect against any kind of market downside.
So when you say diversification, I use the word asset allocation, but you're saying some of your diversification should be between bonds and stocks or other investments.
Exactly. And then when you get into taxes, well, taxes can be a big issue, a bigger issue these days. Several years ago when tax rates were low, it wasn't such a big deal, but nowadays, if you're making a lot of money, especially over $400,000, well, your taxes go up significantly. So when you factor in, federal taxes, state taxes, the fact that your exemptions go away after a certain amount and your itemized deductions phase out, you're hit with an extra Medicare tax of 3.8% if you have over $250,000 in investment income, and then another 0.9% of Medicare or payroll tax. At the end of the day, it's about 50% of your paycheck goes to the federal government.
Unless you live in New York and it's 60.
Yeah, in California it's pretty bad too. So you've definitely got to take taxes into consideration. So if somebody is in that higher income bracket, I may favor some more municipal bonds. Municipal bonds are not taxed by the federal government. And if you own Georgia municipal bonds, they're not taxed by the state government, so it can be a big tax savings. So I may favor municipal bonds. I may also put the bonds in a qualified account or retirement account like an IRA. In that case, bond interest that you earn is taxed at an ordinary tax rate, meaning your typical tax rate as if it were payroll, as opposed to capital gains tax, which is much lower. So I may favor bonds in the IRA to protect you from those taxes.
Now, one of the things we wanted to also talk about today was some specific fact patterns we've actually seen or thought of that go to some of these points. And one thing that I often struggle with is when I deal with clients, and this goes to the education component that we spoke of a little bit ago. A lot of people, Bill, who come to us as investors are watching, the television, and this fella's on TV, buy this, sell this, if you bought X, Y, and Z, you'd be up, so on and so forth. And I think one of the challenges attorneys have, and my perception, Lane, is that advisors have, is trying to deal with that onslaught of information and how that affects people's perceptions of what's appropriate or not. Do you have any thoughts about that, Bill?
Yeah, I think in this information age, people are bombarded with information and they can easily seek it out. I've read something recently about, I forgot what the term is, but it's about applying psychology to encourage people to invest by making it flashy and easy and draw people into investments. And it seems to be a developing area of psychology.
And according to my daughter, if you heard it on the internet, it's true.
Yeah, right. So, yeah, as a lawyer, you have to kind of bring the clients down to earth as much as you can and get behind what they're saying and what they're thinking and find out what the real basis of it is and perhaps explain some things to them that they don't understand.
And one of the other thoughts we had, and as I recall, Craig a number of years ago handled a case that dealt with this issue, Lane, which was we had a trust with income beneficiaries, people who received income for their lives, and then the remainder, the balance, went to others. And there was a dispute about how that trust was handled. As I recall, the income beneficiaries were complaining that the income wasn't high enough, and of course, you know, that is a risk-reward matrix that someone like you is sensitive to. How would you go about trying to deal with that type of situation, which is not an uncommon way many trusts are structured?
Yeah, a trust can be tricky, and you know, you were talking about taxes earlier. You have simple and complex trust, and you know, complex trust, the top tax bracket hits about $12,000 in income, which is, you know, not much. So you can easily get hit with some pretty hard taxes in trust. So you need to also be careful investing and what you invest in those. As far as what you're talking about, I mean, it depends. You know, it's not much different from a person who wants to leave a significant amount of money to their heirs when they pass away. We would take that in consideration when we're developing a retirement plan. We would assume that we had, you know, they want to leave $1 million when they pass away, and we'd come up with a date that we assume that would happen. I would probably approach the trust in the same way. I would sit down and, you know, try to understand what the client's goals are, and if that was the case, if they needed to leave money, well, it's just it's a basic retirement plan that you put them through, and you can analyze that and determine, you know, okay, here's how much income you can take out every year, and here's how much we believe that you will have once you pass away at this date.
Is that what some people call a Monte Carlo simulation type of analysis?
Exactly. Whenever we talk about retirement planning, you want somebody to run a Monte Carlo simulation, meaning that it's basically a computer-generated estimate of what you believe, or what returns are expected to do over the next so many years. So we usually use 95. So if you're 30 years old, we assume that you'll pass away at 95. That's 65 years of returns that you need to estimate in some way, and Monte Carlo is the best way to do that.
You're listening to Wealth Matters, the radio show where we discuss the opportunities and challenges of preserving wealth. We're talking with Bill Leonard and Lane Steinberger regarding issues and challenges in structuring and managing an investment portfolio. And your hosts today are Robert Port and Craig Frankel from the fiduciary litigation law firm of Gaslowitz, Frankel.
Bill, one of the issues we sometimes see as attorneys is, in my sense, some confusion between clients and the advisor as to who gives directions. This often happens in a husband and wife situation, or maybe we have an elderly person and a younger person who becomes involved. Can you speak to some of the issues that either you've seen or you sense happen in that area with respect to how each side of that equation deals with those challenges?
Yeah, that's a good point. And it is a sticky situation for both let's say the husband and wife, or the older person and the younger person on one hand, and for the broker on the other.
Which may still be husband and wife.
Yeah, right, exactly. It's very easy for the broker, I think, to just deal with whoever the dominant customer is and ignore the other one, because that's the easiest way to accomplish the day-to-day operation. The problem is the broker owes duties to both of those customers, and the broker needs to find a way to educate the other customer, make sure that what he or she is doing is appropriate for the other customer, and make sure the other customer is on board. Now, if the two customers are not on board, that's another problem. Then the customer...
How do you resolve that as the broker or as the financial advisor?
Yeah, that's going to be tough. If one of them has a very low risk tolerance and the other one wants to speculate, then there's got to be some way to resolve the two. And I frankly don't know how you do that if they're determined that they want two different things.
Now, one of the things we often see is that an elderly person, or maybe perhaps not even elderly, but someone is given a power of attorney to someone else, and that person with the power of attorney then takes it upon themselves to have input into the account. And again, it's a situation where you could have someone whose goals and desires with respect to the account are very different than the person whose funds they actually are. Lane, as someone in the business, how do you deal with that? Is that a compliance issue for you? Do you have any?
Well, we deal with that on a regular basis. It's usually not a big issue, but it depends. So, and say they did have different risk tolerance and different views on how the portfolio should be invested. First of all, if they each have IRAs, they're in individual names, so that's pretty easy because you can't put an IRA in a joint, or you can't title it jointly. It has to be in the individual's name. So we can manage that separately if that's the case. Usually it's the joint account where the question may be, where they're both sharing an investment account and they have a significant amount of money in that account. I just have to sit down, work with the clients, and try to get them to agree on something. It may take a while, but generally I can get people to agree on how that account should be invested. A lot of times one spouse is going to be uncomfortable, but if we can kind of get them halfway there, then it's usually okay. When we're doing retirement planning and such, it's usually the wife. I hate to say it, gentlemen, but it's usually the wife that lives longer. So we usually, when we've got somebody with two different ages, we're usually basing everything we do on the wife's age.
How are you addressing the issue that end-of-life care costs so much?
That's an issue, and again, that's a thing that the younger people don't think about. The first thing we look at is long-term care insurance. You definitely want to try to get that probably around age 55 or so, they say. But try to get a policy. It depends on how much money you have. If you have $20 million, you're not spending a lot. You're spending $50,000 a year. You're probably going to be okay and don't need any kind of insurance. But in most cases, the normal people may need long-term care insurance, and it's not just about nursing homes. Keep in mind, long-term care insurance can also handle home health care also, and having a nurse come into your house every day.
And I'm seeing the difference that statistically, I think everybody's going to have some need or care at the end, but the differences between spouses, one may have need and start legitimately spending the money, which is great, until the second spouse also becomes ill. And how do we address that when we're getting to even 55-year-olds investing their money?
Well, again, you've got to get the spouse to agree, it's just a situation. Again, it's a tough situation, but you just have to sit down with the other spouse and try to get them to control it. And again, definitely have some sort of insurance in place to protect you in that case. And the example I like to give is Alzheimer's. They say on average, Alzheimer's can be a 10-year situation where you may spend $1 million or more. Most people are not prepared for that. So get some sort of insurance and make sure you save plenty to hedge yourself against any of those healthcare costs. That's kind of the X factor these days is, what's healthcare going to be? Is Medicare going to be around? There's all kinds of issues with the Medicare system right now. Probably not in the next 10 years, but 20, 30 years from now, who knows how much healthcare the government's going to provide and how much you're going to have to provide.
Well, I'm confident it will be me having to provide it. I can't tell you the form or why or how. We are nearing the end of our show, so I'm going to ask each of you if you could give advice to a prospective investor who's going to be thinking about investing their life savings, and hopefully it's a lot of life savings. What would be the advice you would give? And Bill, we're going to start with you.
Okay. I would say, well, first I'd want to know what this person's experience with investing was. But assuming the person doesn't have much experience, I would say get on the internet and educate yourself as much as you can about the basics of investing. And then interview more than one, probably several potential stockbrokers. And see what kind of rapport there is, evaluate the person. As you said earlier, look up each one on the FINRA website.
Explain what FINRA is for the normal person.
Yeah. That used to be called the, what was it? NASD, yeah. It's now the governing body that all brokers are required to belong to, and if there is a dispute, there's an arbitration proceeding that FINRA sponsors, and they provide the arbitrators for it. Yeah, you pay for the service, and it's a streamlined way of adjudicating a dispute where you don't actually go to a lawsuit.
And FINRA, for our listeners, stands for Financial Industry Regulatory Authority, and I believe the website is FINRA, I believe it's .com. If not, it may be .org. The other place you can look for background on advisors is on the SEC site, sec.gov. And without getting into the weeds too much on this, different financial advisors are registered either with FINRA or through FINRA or with the SEC. So you should check both sites and just do a general Google search to see what you find about the firm and the individual that you're looking to manage your assets.
Okay, Lane, your prospective customer, so they may not choose you, but then again, they may, depending upon your answer to this question.
Well, first I'm going to start with save, 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 and save more. That's my biggest issue with clients. Start saving right away. The younger clients out there, start it right away. If you have a 401k at your firm, definitely put in as much as the match. The match is free money. Take advantage of that. So that would be my first advice. And then about finding advisors, it's like what we talked about. There are a lot of unqualified people out there managing money. First and foremost, look for a CFP for financial planning. They have a website, cfp.net, I believe. To actually manage money, use a CFA. And you can find CFAs at cfainstitute.com. I believe that's the website. Don't hold me to that. And also look for a fee-only planner if you can. NAPFA is a good site to also go to, NAPFA, to find fee-only planners.
Let me add one more thing, and that is there's an old expression that if it sounds too good to be true, it probably is. I do some Ponzi scheme work where people come in and they've been promised a return that just sounds too good to be true, and it almost always is too good to be true. It's a false promise, and the money's actually getting moved around. New investors' money is being paid out to the older investors to give them those higher returns, and eventually that house of cards is going to collapse. And even if someone has a gain on a Ponzi scheme investment, the receiver or the government's going to come after them for the false profits that they earned because they weren't true profits. They're actually somebody else's money. So anytime people see these investments promising extraordinarily high returns, there should be a lot of bells and whistles and warning signs going off.
And that's one reason, Bill, why it is so important, as you just suggested, that people do their research, because to understand that a Ponzi scheme is making promises that are inappropriate, one needs to understand what a fair return is. And it's not 3% a month or 40% a year. It's very different in legitimate investments. And if someone has that sensitivity to a benchmark of what is appropriate, they will hopefully be able to avoid Ponzi schemes. We are at the end of our show, so I'd like to ask each of you to remind our audience of who you are, give us your contact information, your website, any social media that you have that our listeners may want to connect with you on. And let's start with you, Lane, first.
You can find me at www.redwoodwm.com. That's Redwood as in the redwood trees, WM as in wealthmanagement.com. Or you can just Google Redwood Wealth Management, Alpharetta, Georgia, also. And feel free to email me too at lane, L-A-N-E, at redwoodwm.com.
And what's a phone number if anyone would want to reach you the old-fashioned way?
The old-fashioned way, 678-527-2800.
Bill?
All right, I'm Bill Leonard, or William G. Leonard. On the website, it's www.taylorenglish.com, and you can find my bio there. My email address is bleonard@taylorenglish.com, and my phone number is 678-336-7162.
I want to thank everyone for listening to Wealth Matters today, where we discuss the opportunities and challenges of preserving and managing wealth. For more information about Gaslowitz Frankel, please go to our website at gaslowitzfrankel.com And remember to follow us on Twitter at Estate Dispute using our show's hashtag Wealth Matters. Our guests today were Bill Leonard and Lane Steinberger. Please join us every fourth Wednesday of the month at 8:30 a.m. here at Wealth Matters on Business Radio X.
Clear.